Quick question. Which of these three different positions would be the best as far as living off dividends the fastest? Now, I want you to think about this answer as we go along throughout this video, even though the answer may seem very obvious. However, I think there's something that a lot of investors aren't talking about when it comes to investing into stocks and ETFs with the goal of living off that passive income. So in this video, we're going to go over those three different positions and figure out which one will have you living off dividends the fastest. But then I'll give you the answer to the question you should be asking. It's safe to say that everyone that's investing in dividend stocks or ETFs is doing it so they can live off that passive income at some point. But financially, what does that mean specifically for you? In order to figure that out, the first thing that we all have to think about is your average cost of living. According to an article on edvoy.com, the average monthly living expenses for an American, including groceries, rent, and utilities, comes between $2,000 to $4,000 every single month. So for this video, we're going to use $3,000 as an example. It's just the middle number, and we're going to assume that's the average of the average for an American. But again, which of these positions is going to get us there first? As a dividend investor, the first thing you're probably going to look for is a stock or an ETF with a high dividend yield, something like Realty Income. Being one of the most popular monthly dividend paying positions out there to the point where they're dubbing themselves the monthly dividend company, Realty Income makes its cash off long-term agreements with tenants ranging from Dollar General to Sam's Club. And in order to maintain the title of a REIT in the stock market, it must pay 90% of its incoming cash every single year to shareholders in the form of dividends. So that's part of the reason why Realty Income has a 5.81% dividend yield, and based off its share price, it pays out $3.08 per year per share. Getting paid monthly does a lot of magic to the mind, especially because you're also paying your bills every single month, and with a position like Realty Income, it has been able to pay and increase its monthly dividend payouts to shareholders for over 26 years, making it categorized as a dividend aristocrat. Now, being someone that invests only $30 a week, if I were to invest my $30 a week into Realty Income starting from $0, it would actually take me about 46 years to make over $36,000 per year in dividends, or about $3,000 per month, accomplishing my goal of living off passive income. But if we don't have to wait 46 years, should we? Johnson & Johnson is one of the most popular companies in the entire world, responsible for everything healthcare ranging from pain medications to Band-Aids. With that comes a really nice dividend yield of 3.35%, meaning it pays its shareholders a little over $5 every single year per share. What's even better is that Johnson & Johnson has consistently paid and increased its dividends to shareholders for 61 years, making it one of only 54 different stocks in the entire stock market to do that consistently for at least 50 years. So for someone that really wants to live off passive income with dividends, this is a really safe bet. Now, same situation as Realty Income. If I started investing into Johnson & Johnson with $30 per week, it would take me 40 years to make over $36,000 per year in annual dividends, so 6 years less. But let's see how fast QYLD can get us to financial freedom in the same exact situation. QYLD is an exchange-traded fund that collects premiums on selling covered call options within the NASDAQ 100, and that's just basically the largest 100 non-financial companies within the NASDAQ. This is a very popular ETF, primarily because it has a dividend yield of almost 12%. It pays its shareholders a little over $2 every single year per share, and especially considering the fact that its share price is about $18, it's really exciting for shareholders to be able to buy whole shares at a time if they don't invest as much. Investing $30 a week into this position would actually get us to $3,000 per month in 26 years, almost 20 years faster than both Realty Income and Johnson & Johnson. So to be honest with you guys, if I had to choose to be financially free either when I'm 77, 72, or about 58 years old, then I'm probably going to choose QYLD and be before 60, where I'm hopefully energetic enough to do other things. So we answered the first question. QYLD is definitely the position that's going to get you there the fastest. But there's another question that not a lot of people are talking about. Will it keep you there the longest? So it's 26 years later and you're living financially free after investing $30 a week into QYLD. You're able to do everything you want to do, including traveling and whatever makes you happy. Hitting that passive income goal may mean you don't have to contribute money into your portfolio anymore, because You don't really need to. You've already hit your goal. And that definitely means that you're not going to be reinvesting the dividends because you need those dividends to pay off those monthly bills. When you compare QYOD to Realty Income and Johnson & Johnson, it's initially the best pick for investors when you consider total returns. That's the amount of money you're getting back from share growth when you reinvest the dividends that it pays out. However, when you stop reinvesting those dividends because you need them to pay those monthly expenses, you're going to want to look at regular returns instead of total returns. When you look back at QYOD in that case, you'll notice that it has a negative return history of 2.7% since its inception date, including about an average of a 5% drop over the past 5 years or so. Realty Income, on the other hand, has a positive average growth of 2.7%, even though the past 5 years and the past year haven't been the greatest. And Johnson & Johnson has an average growth of 5% every single year for the past 10 years. So once you reach $3,000 per month and you decide not to contribute to your portfolio anymore and you accept the fact that you're not going to be reinvesting those dividends because you can't, you have to really start to think about how long is that going to last for you based on your living situation. And did we also forget about inflation? The situation we put ourselves in at the beginning of this video was based off the cost of living, which is an average of $2,000 to $4,000 per month for Americans. But that's based off in 2024. Over the past 30 years, inflation on average has increased 2% every single year. So if we follow that same trend that we had from 1994 to 2024, $3,000 in living expenses now is probably going to be worth $6,000 plus in the next 30 years. So you really want that yearly average stock growth to be more than 2% if you want to be able to keep up with inflation and make sure your living expenses are still livable. And that's because you're not contributing dividends back into those positions. And speaking of dividends, you also want to make sure that that position will keep you financially free, meaning not only the share price average is higher than inflation, but your dividend position is at least increasing every single year. So that means you want to be able to have a dividend position that has a long-term history of paying its shareholders and increasing those dividend payouts to their shareholders. When you consider inflation, QYOD will still get you to your goals quicker, especially if you put in a lump sum of money rather than the $30 a week, for example, that I was saying. But when you look at its dividend history, you'll notice that it unfortunately has a history of its dividend decreasing by 1% every single year. So with things getting more expensive over time, it's probably not the best idea to invest into something for the long term whose share price goes down along with its dividend yield. With all that being said, when you recompare these three positions based on regular returns and not total returns, Johnson & Johnson is definitely going to be your best bet, followed by Realty Income and QYOD. Now, don't get me wrong, that doesn't mean that you shouldn't invest into QYOD at all. I think the purpose of this video, or at least part of it, is just to emphasize the risk that you'd be taking into investing in certain positions with a really high dividend yield. And if you're someone that's a lot younger, whether you're my age in your early 30s or you're even younger, then you have more of an advantage because you have more time to potentially make up for losses, or you have more time to take advantage of those high dividend yields. Positions like Johnson & Johnson, or even something like Apple or Nvidia that don't have a double-digit dividend yield, should still be considered because of their tremendously positive long-term share price growth history. But the other thing you want to keep in mind is that the amount of money that you invest into your portfolio plays just as big, if not a bigger role than the positions you're actually investing into. I'm in a bit of a tougher situation right now because I'm only able to invest about $30 a week just based on my budgeting, but that doesn't necessarily mean that I won't eventually hit certain investing goals in my lifetime. Like, for example, reach $100,000 in my overall portfolio, because I know a lot of investors really look forward to that. And I actually find out how long it would take me to get to $100,000, and I talk about that in this video, so make sure you check that out, because what's really cool is not just getting there, but what happens next. So hopefully you guys check out that video, and hopefully you guys enjoyed this video. And until next time, as always, take care.